All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here after another FOMC release and Jerome Powell presser. I am joined as usual by Fed-watcher and head of Merk family of funds, Axel Merk. Axel, how are you doing today, my friend?
I do great. And I see you in Nevada. Exciting as the Fed might be. You really want to hear everything about the move to Reno.
Okay, folks, I will spill all the tea on that soon, but not today because we have a lot to get through. I am traveling, as you can tell by the different background. Well, actually, yeah, lots to talk about the whole Reno move. But yes, different location today. About to catch a flight in the next, 36 hours or so to Ireland for all of next week. So lots going on here. Bear with us. We started a minute late because we were trying to troubleshoot an echo issue on Axel's end. I think we've got it more or less under control. If you're hearing an echo on your folks' side, just let us know. We'll do our best to deal with it. I am hearing folks are saying you are echoing a little bit, Axel. We had this issue with Stephanie Pomboy a little while ago. I'm not sure why this is going on. Well, we're going to try to soldier through this as best we can, folks, especially because I have been traveling, not only traveling, but getting interviewed today and doing interviews, Axel. So I didn't get a chance to watch the Jerome Powell press conference. Folks, as you know, I normally do my write-up afterwards of that, and I go back and forth with Axel on my interpretations versus his. I'm going to have to rely heavily on his expertise today because I'm coming at this with seeing almost no news, Axel, except I know they kept the Fed funds rate steady, which everybody expected them to do. Presumably, they didn't touch QT. I'm not sure if I saw anything on that, but presumably they didn't touch the pace of QT. You're shaking your head. Okay. And then I started reading your X feed on this, and you posted a picture of deer in the headlights. So I guess let's start with this question. Is the Fed being prudent and patient here, or is the Fed too late?
Well, the Fed, as we have discussed many times, does not have a process. And that's really the problem right now. That the Fed sees that inflation might be going up because of the tariffs, but at the same time, service inflation is going down because the economy is going down with the higher rates. And they don't have a good deal way dealing with it. Powell refers to it as a supply shock. As a reminder, tariffs are a supply shock. And the pandemic we had a supply shock. And so they don't want to lower rates until they know more. And when he was asked specifically what he's looking for, he didn't give a straight answer. He talked about the quote-unquote totality of data and other things. And so he basically didn't give a good answer. And so that's why the market interpreted it to be hawkish, because they're like deers in the headline. They're worried about doing anything because they're worried they might be doing the wrong thing. And the reason I don't answer your question is because I question their framework. If within a given framework, you kind of, yes, you could be early or late, ultimately, the problem is they don't want to be seen as flip-flopping. And so they want to stay the course. A good way of phrasing it is they want to be patient. But of course, the economy is moving on. And by definition, they'll be late if they wait for all the beans to be spilled before doing anything.
Okay, and Axel, just real quick, I think I found a triage to our echo issue. So I muted myself while you were speaking. That seemed to end the echo on folks' part. What we might want to do here is a little back and forth, which is when I'm talking, you might want to mute yourself, and hopefully that fixes the echo, at least, Band-Aid wise here for folks. And I see you've done that. Okay, thanks. All right, so where to start? Let me address the red line of the FOMC decision, because the thing that caught my eye there, separate from just sort of the short-term drama of the two dissenting governors, and that's the first time I think there's been two people dissenting on the FOMC committee since like 1993 or something like that. But they changed the text economic activity has continued to expand at a solid pace, to the growth of economic activity moderated in the first half of the year. So I think it's natural to assume that somebody reading that would interpret that as, okay, the Fed is actually seeing the economy starting to slow here a bit. Maybe not catastrophically, maybe not, hair on fire, but, if that pace were to continue, then you might want to actually start to get worried about economic weakness, then further labor in the jobs market, et cetera. And that might be, a rationale to then make a case for cutting. Now, again, they're not doing that right now, but is it a material that they made this red line shift here?
Well, you're asking a deep question of whether these little word changes really matter all that much, and why not keep it simple? As a reminder, the Fed used to not give a statement at all in the quote-unquote old days, and then give very brief statements. And then during the pandemic, these statements ballooned to long essays, and it's gotten much shorter. I would say shorter is generally better. And the one thing I think that's the most noteworthy thing about this statement is that it doesn't talk much about the disagreement, because presumably they couldn't agree on what they disagree on more specifically either. During the press conference, it became clear that Powell is more optimistic about the jobs market than Chris Waller, who is one of the Fed governors that disagrees. And by the way, not only is it unusual for folks to disagree, it is particularly, at least historically, unusual for Fed governors to disagree. As a reminder, there are Fed governors, they're political appointees, and then there are Fed presidents, and they're kind of industry appointees. And the industry appointees tend to be far more renegades, historically speaking, whereas the Fed governors historically are far more conformist. And so that's why it's a quote-unquote big deal. Now, every person is different, and one can't generalize, but that's kind of why it gets the attention. But to go back to your question, I think just about everybody agrees that the Fed policy is moderately, somewhat restrictive, although you could be forgiven for missing that if you look at what's happening in the meme stock era that usually happens during economic periods. Powell did explicitly say that nobody knows where the neutral rate is, that you only know it with hindsight. And I think that's a very, very fair point. And he's been reiterating that a few times. And so that's very fair to make. Chris Waller in particular thinks the economy is weaker. And by the way, it's almost Michelle Bowman is the other person who dissented. Chris Waller gets all the attention because Chris Waller is an economist. Michelle Bowman is a regulator. And so when a regulator disagrees on interest rates, the financial insiders are shrugging it off as just the opinion of somebody. Whereas when the economist does it, then maybe there's some substance to it. And I'm not going to dissect on how good economists are or not. But Chris Waller has provided thought leadership on the economy more so than Bowman, who is mostly known for her views on regulatory policy.
Okay, so I'm interested. There's a lot of drama, headline drama over the past couple of weeks of, will the president replace Jerome Powell? I don't think anybody really thinks at this point that he's actually going to do so. And I don't necessarily want to rat hole on that with you here, Axel. But is some of this dissenting, do you think, political posturing / cozying? Sort of setting a signal to Trump that like, hey, I may be more on your team here than Powell?
Well, you can never rule it out, but yes, I teased this morning that, this morning it said, there might be two dissenting voices. And of course, the thought was, well, do two of the folks from the Fed want to become Fed chair? It's being a little unfair. In part, I've met Chris Waller several times at conferences, heard him speak, and he is not a political guy. in his defense. Now, of course, that said, if you want the job, so why not try to get the attention of somebody? And I have seen others who've been in the running before who are suddenly talking a little bit differently when they're under consideration. And I'm not talking about this time around, but in previous iterations when the Fed chair was being considered. So of course one can't help but think that. But Chris Waller has a record of going against the stream when he feels like it, and in that sense, you kind of want that in a Fed chair who kind of stand for themselves. So I would think that if anything, Chris Waller's disagreement speaks for his backbone more than anything else. Now, again, the reason why I am not saying like Powell is right, Waller is wrong, or vice versa, is because I really want to see I have a problem with a lack of framework. If you had a rules-based Fed, then you could lower rates based on whatever the Taylor rule or whatever says, and if the market is off, then you change your mind and you go back up. When you have a discretionary Fed, which is what the Fed is called, where everything is decided by committee, then the market may think, oh my God, they're wrong yet again, and the Fed's credibility is eroding, and that's why they almost have a duty to be late in this, so that having been wrong before, they just don't become irrelevant, and the market loses trust in them. And Kevin Warsh, one of the candidates, he said as much in the speech that when you have been wrong with your policy, the way to regain market confidence is to stick closer to the rules, right? And unfortunately, Powell is not doing that. He just says, well, we kind of know that we don't know where we are, and therefore we're going to wait. And says, well, what are you waiting for? And he says, well, I can't tell you that. Well, is it this or that? Well, I don't want to get too specific. And so that's all very consistent with somewhat of a lack of thought leadership on Powell's end. And remember, we got this 5-year review coming up, which is supposed to bring in some thought leadership. We have the annual Jackson Hole conference coming up, which again is an opportunity for thought leadership. And yet we have a lame duck who's Fed chair. And so ultimately it is what it is. And rates are not changing. Indeed, as we were watching the press conference going into that, and also yesterday, there was about a 60% chance of a rate cut in September. As the Fed conference was progressing, we went down to just under 50%. And the reason I'm hesitating, we're down at 47.3% as we are talking right now, which is further down from, I think, from just a tad higher, but we have below 50% chance of a September rate cut. Now, obviously, that can change in a whim, but it is noteworthy that the rate cut odds have been lowered, and we're now firmly in a rate cut in October, but we're just pushing out the goalpost, and that's really what Powell has been doing. And the kind of the only news in that is it was generally expected that Powell would try to bring no news in, and by him just not committing to anything whatsoever, he pushed out rate cut expectations. Now, he still has plenty of opportunity. Remember, this Friday we have a jobs report in late August. He has an opportunity to speak in Jackson Hole. There are plenty of signaling opportunities if he does want to cut rates. At the same time, I actually don't think, if he doesn't know what he wants to do, he might as well say it, and that's exactly what he did. And so in that sense, kudos to Powell. At least he's being honest on this.
Quick question, Axel. If Powell were getting ready to be more dovish, but didn't want to cut rates yet, wouldn't he further decrease the pace of QT or maybe end it altogether? Like, is that a initial signal that we should be looking for here before actual guidance of a rate cut?
I think you're giving Powell way too much credit. I don't think he gives the balance sheet much credence. Again, referencing Kevin Warsh, Kevin Warsh believes that cutting the balance sheet is hawkish. Powell thinks the balance sheet is a problem that should go away, but he can't magically get it to be away because he knows if he cuts the balance sheet too much, there are going to be disruptions in the market. And so I don't think the Powell Fed pays too much attention to the balance sheet. They know that a large balance sheet is a political issue, and they'd rather have it go away. That's very different from someone like Ken Bush, who wants to strike a bargain with Treasury to get rid of the balance sheet and make it smaller. And so it's now, does that mean that balance sheet doesn't have an impact? No, of course it doesn't necessarily mean that. But I don't think that's Powell's framework. What Powell indicated is that we got to watch the unemployment number. And I think the reason he says that is that if the economy were to kind of plunge, then action needs to be taken. But otherwise, they should rather be patient. And again, the backup is, of course, they messed it up last time around, right? They really messed it up with the pandemic. And so they don't want to be seen messing it up again. And the 1970s had the same thing, right? There was the equivalent of tariffs came into place, oil shock came, and other things, and they were cutting rates. And so they don't want to be seen as being weak on inflation.
Okay, so given that, then, today's data that we got, the stronger than anticipated GDP growth numbers and the better than expected ADP jobs numbers, obviously kind of gives ammo to Powell to be like, yeah, see, nothing's breaking, so I should wait.
And that's his view, and he's in charge, and Chris Waller and Michelle Bowman respectfully disagree, right? And they have 2 votes. Neither of us have a vote, and so our opinion probably matters even less. But yes, that is why the market came down today, because the Fed was considered to be more hawkish. By the way, one thing, since you didn't listen to the press conference, you probably didn't hear a comment either. After the press conference on Bloomberg Radio, the question came up, why did Powell say, and I think he said it more than once, that this might have been one of the better FOMC meetings. And so Jonathan Farrow from Bloomberg asked William Dudley, the former New York Fed president, what does that mean? And he says, well, that's Fed speak for saying we're all still friends, even when we disagree. And so that's what you call a better meeting. And he's basically downplaying the disagreement. And I at least in William Dudley's point of view, that's fair enough. It's appropriate to downplay it.
Okay. So you mentioned that during the press conference, folks got the sense, I'm guessing, not having watched it, that, okay, Powell is still feeling pretty comfortable in his inaction, right? That his bias is towards really trying to make sure inflation's dead, and he's not going to be cutting anytime soon. And so the probability of the rate cut in September started dropping the way that you said. So markets have had an immediate allergic reaction to that, perhaps not too unsurprisingly. So last I looked, the S&P was down maybe 0.5%. The precious metals are taking it on the chin pretty hard right now. So is there anything about the market reaction here that you think is noteworthy or worth talking about?
So I take exception to your choice of word comfortable. I don't think Powell has been very comfortable in just about anything of late. His tour of the construction site, I don't think Powell looked very comfortable, and similarly, he of course needs to represent the view, but I don't think he's in a place where he wants to be. He extensively talked about how kind of the 2 mandates are not in sync, and this is a unique situation, and so forth. So I don't think that's how you express comfort. That said, I think he has firmly come to the conclusion that given that on the one hand you have inflationary pressures from tariffs, on the other hand you have a weakening economy, but only a slightly weakening economy, that he's come to that conclusion and can defend that point of view. And by the way, a lot of these tariffs haven't really taken effect and whatnot. And the philosophy is, of course, on the one hand, that tariffs have a one-time impact and then we move on, right? But a role of a central bank is that they're not so-called second-round effects. And that's really where he is, that he doesn't feel comfortable, to use that reference, to lower rates. Now, Il Presidente has a different point of view and has been touting that on social media and says, well, let's lower rates, right? And ultimately, I think the one thing we can argue about whether we should be here or slightly lower, the days of zero interest policies are over for the time being. The other thing that I think we should be aware of, because we talk about interest rates, longer term rates don't necessarily come down simply because short term rates come down. And I think, and Treasury Secretary Bessent, he had said that he keeps the refinancing of government debt and the new issue debt very short on the maturity side because he's waiting for new Fed rates to come lower. I'm not sure how serious he is about that, because Bessent is somebody who understands the markets.
He knows.
So he might be doing the political talk like most people do, but longer term rates might just be stubbornly high. And there are a few reasons they can be stubbornly high. One is because the economic growth potential is improving. That would get long-term rates to be higher. Think deregulation. Another reason is that maybe deficits need to be financed more domestically because tariffs impact financial flows. That's been my school of thought, that there is a serious impediment to financial flows, and that is part of the reason why long-terms are higher. And of course, the market may be pricing in this debt binge that Congress and the lack of willingness to address deficits. By the way, to put some substance behind some of these numbers, one number that is somewhat relevant is the long-term real interest rates, then 10-year real interest rates, and that's back below 2%. Now, I know many of your viewers don't give much credence to that number because nobody knows what inflation will be in 10 years, let alone real interest rates. But it's a market metric that can be measured on the CPI anyway, and it matters when and so when the market believes that longer term real compensation through treasuries is going down, that tends to be a positive for gold, which is ultimately a neutral entity, right? It's a brick that doesn't change. Whereas if the purchasing power on cash over time is eroded, then gold might be more valuable versus, and vice versa.
All right. Well, so I was going to ask you about this. So why don't we go there for sure? By the way, it does seem, from what I can tell in the live chat here, that the echo problem has been more or less solved by our Band-Aid patch here. Folks, let me know if that's indeed true, just so I'm making sure you're all hearing us here. But anyways, Axel, I think it's working, so thanks for soldiering through this. All right, so gold. Let me ask you this, and then folks, if you have any questions for Axel, ask him in the live chat here, and I'll start pulling them in. So, you talked about negative real interest rates decreasing as we go out further in duration, expectations for them. So that is gold positive, as you talked about. I'm guessing that's one of the reasons why you think gold has done so well of late. And even though the precious metals have had, I'd say kind of a rough week or so, part of that's just they ran so far so fast. We knew that there was going to be some sort of, pullback, given how extremely far they came so quickly. And today's Fed news, if you think the rates of the odds of a Fed cut have dropped, then yeah, you're gonna take a discount off the precious metals for that. But in general, taking the totality of everything that you look at in the precious metals sector, what are you seeing right now? What is your latest outlook on the metals themselves and the miners as you look towards the second half of the year here?
The first thing I might want to say is gold has done well despite higher long-term rates. And in my view, that is precisely because of the reasons for the rates to be higher, and notably the tariffs is a key factor, and the concern about deficits. Many of the so-called fringe views of the gold bugs are moving more towards the mainstream. And just on the margin, because the market isn't that huge, you have more people buying gold. That can push up the price of gold higher. And just on what our own work, we do see there's demand on weakness in the space. And I believe part of it is that, as a reminder, right, we are in this state of the economy where we are constantly worried about a recession, yet it hasn't happened. And in part, it may not have happened because the Federal Reserve is more micromanaging the economy. I'd like to remind people of the bailouts they did of the banks that mismanaged their duration risk. But part of it is, of course, we got these two currents coming up in. We got the tariffs that slow down economic growth, but we got deregulation on the other hand, and so forth. But markets are forward looking, and so having this constant fear of a recession without it actually happening is just fine for the price of gold. What is not so great for the price of gold is a higher for longer environment where we have a deeply restrictive policy. And in that sense, the sell-off in gold today is consistent with that. I'm not saying we're going to have kind of forever higher for longer, but relative to earlier today, we are in a world where the Fed is a tad higher for a tad longer than was previously priced into the market. And so all else equal, that warrants a slightly lower price of gold. And I'm not trying to forecast here what the market is going to do, just explaining the market reaction here. And of course, the other thing that's, in my view, going to come up, we are going to at some point move beyond the constantly changing news flow on tariffs and focus more on the midterm elections, where we'll need to get good news. Need in the sense of, from the administration's point of view, they want to have success stories, which means we'll get drips and drips of deregulatory action and other positive information for the market. And so we'll have to see how seriously the market thinks that these are game changers or just sound bites. And it's one of the reasons why I like to look at the 10-year real rate. When it is significantly above 2%, that suggests to me an expectation of a more restrictive policy. And again, these 10-year measures are more of a reflection of market confidence of where inflation, where monetary policy is going to be, and how effective the Fed is going to be in pursuing that. And with all that said, the next Fed chair is going to be extremely important because, as I pointed out, I don't think Powell has much intellectual leadership. I think he's a lame duck. And so it matters who's going to be there next. And that can significantly impact the markets, including the gold markets.
Okay, and let's talk about who's going to be there next. I just want to test something here with you live, Axel. Michael here recommended that I try earbuds and see if that might prevent some reverberation that might have been going on my end. How are things sounding to you? It looks like you've unmuted yourself. Are you still hearing the feedback you were, or have we resolved that
yes,
with earbuds?
And you can hire this fellow as your tech support, yes.
Okay, meaning yes, it's fixed the issue?
Yes, you had an echo because your notebook didn't have proper echo canceling, yes.
Interesting, okay. All right, sorry about that, folks. If indeed you're not hearing an echo here with both of us, I will keep these earbuds in and we'll keep on going and we'll know this for the next time. Which is so interesting because I've done 2 interviews today and had no issues with that, but sometimes there's a ghost in the machine. Okay, so you said it really matters who's going to replace the now lame duck that we have at the Fed in Powell. Do you still think, Warsh is kind of near the top of the list? Have the odds changed in favor of somebody else? And let me ask you this: now that everybody is kind of so, okay, good. Looks like this sounds good on people. Kind of everybody is so bought in now the fact that Trump's obviously going to put somebody in there who's going to, I think the expectation is going to jump to Trump's tune. Does that seriously diminish the power of a Fed pronouncement? Because if they deem that the person at the Fed is really just under the thumb of the president, then why don't they just listen to the president?
Well, of course that might happen. None of the candidates are just pawns of the president. And so at this stage, I don't think that risk is there. And also remember, it is of course.
Sorry to interrupt, but is Bessent a credible candidate here? I know his name's been floated that they might swap him from Treasury to there, but is that really credible in your mind?
He's a credible candidate, like others, yes.
Okay.
But he's also, I mean, just think about it, right? Bessent is a person in his own right? And he may well choose a business executive rather than an academic or a lawyer. And they would have a potentially very different style. But any business executive that he might consider presumably has had a successful career and is an opinionated, self-made person or something like that. So, of course, it's possible that he might end up choosing somebody who is a quote-unquote puppet. But I haven't seen that. I think we have to differentiate between the posturing and the policy. And I don't think it is helpful to interfere with Fed policy. I've mentioned this in discussion with you many times. The reason I don't think it's helpful is because if you, and by the way, the far more difficult torpedoing actually came today from within the Fed, right? When you have Chris Waller, who is a credible candidate, torpedo it, that is because that is somebody who could actually succeed Powell, right? And so that is far more relevant a shooting down of Powell opinion than if Trump were to do it. The reason why second guessing the Fed from a credible place is not good is because it makes Fed policy more expensive. And the example I like to give is if there's a crisis, the Fed chair can speak and calm the markets. But if that speech is not credible, then the Fed might need to intervene in the markets. And so that's kind of the most abstract, closest to kind of a why it is not good. That doesn't mean one needs to agree with what the chair is doing, but Fed policy is less effective and it's more expensive for the country as a whole if you have true interference. Now that's very different from the political bluster that you see. And indeed, the market did react. Most people remember when the New York Times wrote that Trump had written a letter to Powell. Well, it turns out it was only a draft. And so it was, again, just a bluster, and then who knows what it was exactly and why exactly what the New York Times know about a draft that Trump had written. But when it's credible interference, it matters. Let's not forget that that it is extremely convenient politically to blame the Fed. We blame the Fed for a lot of things. Well, politicians, they thrive on it. Now, is it politically, it may be the right thing to do. Economically, it's not a good idea. And of course, Trump has taken it to levels that others have not, including that.
But that's Trump. He dials everything up.
Well, exactly. Well, it doesn't mean one needs to like it necessarily, right? But it is that in itself, right? We can roll our eyes, we can do this or that, we can, but it's mostly plays to politics. What matters for the markets is where the anchor of the risk-free rate is. Right? There's of course other things that the Fed does on the regulatory policy side, and maybe one should separate that a little bit more. But what matters for the markets is where the anchor of the risk-free rate is. And then everything around it is secondary, or at least it should be. And more specifically, the Powell Fed, but before that, the Yellen and also the Bernanke Fed have dragged the Fed into more and more areas that step on political turf. And that just creates a really destructive feedback loop. And Powell and many others don't get it, whereas Kevin Walsh is somebody who gets that. And that's one of the reasons why I favor him, is because he's been talking about reforming the Fed before Trump and when Trump was not in office, saying a lot of the stuff needs to stop. And so the difference between Walsh and the other candidates is that the other candidates will have more of the same. Sure, they may not be a Powell and will have other pros and cons, but as far as fundamentally reforming some of the things that happen at the Fed within the confines of the law, right? I mean, if Congress changes its minds about the Fed, it's another thing. But Walsh has numerous ideas that within the confines of what the law is, you can get the Fed to be more effective and get it out of politics. Now, does that mean if Kevin Walsh were to be the next Fed chair and he wouldn't lower rates, that Trump wouldn't lash out at him? Of course he would. But it is still helpful to clean up the place and get rid of many of the bad habits there.
Okay. All right. Well, look, Axel, I know in the long run, you'd probably love that, right? You'd love somebody like a Walsh to come in and quote unquote clean up the place, put in, data-driven decision-making, a framework that everybody can kind of understand. Let me ask you this: in the short term, though, like now, between now and the end of the year, what specifically would you like to see from the Fed? And I guess in that question is, it's like, do you think they're too late here, or do you think they're doing the right thing by holding?
I don't think it matters much. Because it just, the markets are discounting mechanism. So what the Fed does today or tomorrow matters much less. And if it doesn't really matter whether they keep rates where they are or lower them by 25 basis points or not. This economy is slowing down. What if they lower rates? They need to. What they don't have is they don't have this escape hatch, right? They don't have this escape hatch that if they're wrong, they raise rates again. Powell has positioned himself that if we lower rates, we're going to continue lowering rates. We're not going to turn around and hike rates. And that's just a very bad place to be, right? So if I had a choice, and even let's say we keep, and of course, then the Fed's not going to change the way I want them to change, but there have been plenty of Fed chairs in situations where even in a discretionary environment, they change their mind. They lower rates and then hike rates again. It is possible. But for some reason, Powell has said as much that no, he doesn't want to be there. And part of the issue is that, of course, inflation is not linear, right? Let's say he were to lower rates and say, okay, if this happens, we'll hike rates again. And guess what? The next rate that month that happens. And then it turns out to have been just an aberration in the data. And that is really the challenge, that institutionally the Fed is very, very slow. By the way, one of the things Kevin Walsh at some point talked about is that he wants to use more real-time data. Because right now, kind of the data that the Fed is using is from the Stone Age. It's months old. And so the economy is moving in a direction. Remember, Fed policy acts with a lag, right, of numerous months. And so if the Fed wants to wait for real damage to be there in the economy, of course they'll be late. They say that that's an acceptable trade-off because they don't know what inflation is going to do, and that's a fair point. And so to answer your question, yeah, I mean, I'd rather be here criticizing the Fed than being the Fed chair actually making the decision.
Mm-hmm. Let me ask you this on that last point, and then we'll start wrapping things up here. If the economy is slowing, and you think it is, and the Fed is taking note that its impulse has changed, right? It went from the economy's growing, whatever it was in the red line, to we've seen a notable, whatever it was. It wasn't slow down, but a notable slowing of pace. Don't the inflation fears kind of become tariffs become a little less meaningful, right? I mean, how much inflation would you expect tariffs to do in an economy that really started slow, assuming you thought it was going to start slowing substantially?
Well, Powell said as much, right? Look at the unemployment rate. That's kind of what he said, and that's summarizing kind of what you just alluded to. Basically, if the economy is falling off a cliff, he'll lower rates. That's what he says, and how big a cliff that's going to need to be, we don't know. But yes, so if you continue to have a mixed bag of economic data, they'll probably stay pat. And if you have like 2 or 3 months of negative data, then the rates. And if you look at what the market is pricing in, that's exactly how it works, right? You have a better data point, the probabilities shift a little bit.
And I'm curious, this is a bit of an intellectual exercise, but if tariffs were not in the picture right now, where do you think inflation concerns would be?
That'd be lower.
I know they'd be lower, but would it be a non-issue at this point, or would they still be saying?
Well, it would be. It would allow Powell to cut rates, because I mean, just don't forget the many U-turns we've had on numerous policies through executive policy. Right? Nobody knows where this economy is, and of course, if you favor the president's policies, then it's all crystal clear. It's all part of a grand plan, right? It's strategic uncertainty, as Besson is saying. If you're at the Fed, you may look at it through a different prism and saying, well, I mean, that's the deal, the headline. So that's all very interesting. I have no clue what it all means, so we might as well wait. And so it's reasonable people will disagree on what the impact is. And again, if you have as part of your process that you don't want to be flip-flopping, then you're not going to do anything. And I'm not saying that's the right approach necessarily, but it's based on that process, it's not surprising.
Okay. All right. Well, look, Axel, thank you so much. Folks, I'm going to start wrapping up here. I'll ask you one last question here, Axel, but just real folks watching, if you enjoy these post-FOMC live stream, reaction videos with Axel and I, especially when I've had a chance to do my homework, unlike today, and would like us to continue doing these after every FOMC meeting. I think the next one is in September, as you said, Axel. Folks, if you want us to continue this, if you like it or don't like it, just give us your feedback in the live chat, or if you're watching the replay, in the comment section below. But obviously, I like to listen to you guys and do more of what you like and less of what you don't. All right, Axel. So as we're wrapping up here, is there either a question I haven't asked you yet that you want to talk about, or just something that's on your mind, given either the Fed or just what's happening on the big macro stage, that you'd like to share before we part ways here?
You shrugged that big macro question off at the very beginning. I mean, you said you're not going to talk about it. So that is why you moved to Nevada. That is what interests people. That is what we want to talk about. The other things and other more micro details, as I indicated, right, I would expect more positive news coming out on the deregulatory side. By the way, there was just a new study out showing that Nevada is, again, one of the top mining jurisdictions, and that's in part because of the changed attitudes towards permitting. Permitting is really something you can have a fundamental change on that has a real impact on the bottom line. A lot of the executive actions might be temporary. A new administration might change that again. And so permitting is something that has a tangible impact, where you don't need congressional action, so to speak. Other than that, we'll have to see. I mean, I'm very worried about Europe. As a reminder, we are supposed to have this new pro-business government in Germany. There are two things coming out recently that I just scratched my head. One is they decided, we're going to spend hundreds of billions in infrastructure and ramp up military spending. So the first thing they think about is to introduce a new office that's going to police that people are going to get, workers are going to get paid properly. And of course, in the US, we are well familiar with that. When the government hands out projects, you need to prove that these are union level jobs and so forth, but it increases red tape, right? And then today, somebody came out from the economics ministry over there and talked about how, talked about social justice programs. And this is a conservative government, for goodness sake. I mean, they have a grand coalition. And so I said, okay, so some people have pointed out that the problems that Europe has are not the tariffs. The problems that Europe has is they're not competitive for many, many other reasons. And these are but just two examples of that, right? I mean, people love to blame Trump for things that don't work well when they're on the receiving side of things. But it's often that there's a little bit more to that. There's some competitive deficiencies there. And so if you don't want to talk about you moving to Nevada, that's maybe almost as interesting.
Yeah, so sadly we
I'm
don't
not
have
going to
time.
stop giving you time about that.
I know you would. And folks, we will definitely, I'll do the deep dive on it, just don't have the bandwidth to right now. So Axel, as you know, beyond just the very big secular challenges that Europe faces right now, past couple of days, we just had a trade deal announced between the US and the EU. Trump administration obviously touting that as, biggest deal ever struck in history, and it's great for America. And on the surface, I mean, there's a lot of commitments that the EU has just verbally made that are pretty impressive if you're an American. I'm definitely seeing some headlines from the Europeans saying, "Whoa, wait a minute, did we just give away the farm? I mean, this doesn't feel like a great deal for us." Do you have strong thoughts one way or the other on this?
Well, just as I indicated earlier, that it's good politics to bash the Fed, it's good politics in Europe to bash Brussels, right? So there's a trade deal that's done, and both the French and the Germans are bashing Brussels for coming up with an agreement. So it's good politics. Question is whether it matters.
So,
right?
so is it more air cover to their base, or do you really think that it's okay?
No, it's air cover to the base, because ultimately they have a veto right, and if they really don't like it, they'll veto it, but they won't veto it. And because they're team players, right? These both Macron and Merz are team players, and so they'll complain about it publicly and then sign on the dotted line. It's will remains to be seen. But what you say, of course, is a lot of these trade deals are verbal agreements, and we've seen with the Japanese as well that Trump touting, yes, he's got $1 billion and he can do whatever he wants and the profit, and the Japanese saying, wait a second, not so fast. And so there's like two different movies playing, one for public consumption and one that's more what's happening in the real world. One of the things Europe has said, we're going to import all this LNG. I think that's on the table, but there need to be takers for that, and you need to have terminals for that and all that. And so a lot of that is aspirational. The one thing we have to be careful about is whether other politicians are just playing Trump for time, saying that all this stuff is going to take years to be implemented. Think about the ramp up in military spending. I do think Europe is serious about it, but still, just think about the procurement times. And I think they can just mark their calendar. Well, in 3.5 years, Trump is going to be out, and we'll have done a nice talking, and we'll egg on the president and be on the nice side of things, and then we go back to business normal. And the one thing I like to caution everybody is Trump may be out in 3.5 years, but Trump is just a symptom of a new era that we live in, and so industrial policy and activism by countries is on the rise, not just in the US. Yes, in Europe as well. Asia has always done it, and so the sort of things that we're experiencing, it might not be done in a Trumpian way, but I think that's with us to stay. It's going to evolve. We're not going to, quote unquote, go back to something else.
All right. Well, look, I'd love to dig into this more with you, but don't have time, and it's not fair to ask you these big questions with little time left. Although I'm going to do one last one here. I'm sure we could talk a whole interview about just this question, but give me your 60-second or less version. Do you think the EU holds together over time?
Define over time, how long, right? I mean, the
next 10, 20 years?
Yeah, so whenever I'm particularly negative on Europe, somebody comes out and says and shows that Europe has grown stronger through crises, right? When there's a crisis, they get things done. Just as Congress got things done in October 2008, needed kind of a second round on getting things done. The European institutions tend to grow closer together when there's a real crisis. They really have to figure out how to give the man on the street a voice. A lot of things in Eastern Europe, of countries that are part of the EU, they just don't feel like they're being represented by the EU. And so the question is what the result of that is going to be. And for the time being, it mostly means populist politicians get elected. But of course, there's a reason for that. It's because the EU is all but ignoring the requests, the desires, the needs of the man on the street. Mm-hmm. And so that needs to change. Whether the EU will learn to do that before it breaks up, I don't know. So the short answer is I have no idea. Overall, I do think the world is becoming a more fragile place. I do see a global disintegration on both on finance and on commerce as well. But ultimately, people do want to do business, and so they'll figure out a way to transact. And so I'm evading your answer because I don't know the answer. I can see a bunch of scenarios. What the EU really would like to do is they would like to be able to issue debt that's jointly guaranteed by all the countries in the EU, because then the bureaucracy can really grow and they can do massively more spending. Yeah, well, you're smiling, but I think that's a serious plan. And the more likely there's going to be a crisis, the more likely it is that the different countries in the EU will agree to that. And so it's for the time being, it stays together, right? I mean, they have a lot of homework, but if the reformist government that Germany now has is any indication, I am rather pessimistic that they can engage in true reform. Because if that's the best they got, then they're in big trouble.
Okay. All right. Like I said, lots to talk about there, but we'll have to leave it for next time. Folks watching, thank you so much. I'm really sorry for the audio issues. I think we've got maybe better intelligence for how to deal with this should it raise its head again in the future. But I appreciate you hanging with us here to the end. I will say I'm a little surprised at how few questions were asked for in the live chat. And look, you ask as many or as little as you want. I'm just here to respond to you. But part of these live streams is to let you guys ask whatever questions you want of Axel and or me. So hopefully next time, if you're watching this and said, gosh, I really wish I asked something, make sure you ask us next time. Axel, thanks so much. Folks, please let Axel know how much you enjoyed this and appreciate him coming on to do these live stream reactions by hitting the like button and then clicking on the subscribe button below. Axel, if folks want to follow you between now and your next appearance here, where should they go?
Axel Merk on Twitter is where I can chime in on what's happening on geopolitics. Merkinvestments.com is our website. We manage about $2.5 billion in gold and gold mining. And it's part of the reason why we're interested in monetary policy is because what's happening on the so-called anchor frisbee rates does affect what's happening in the gold space. But we obviously talk about the gold miners there as well and have webinars and whatnot in the free newsletter.
Okay, great. And maybe next time, Axel, we'll do a little deeper dive into what's going on in the mining space. I know you gave us a pretty deep one last time, but it'd be good to get your update next time in September. And obviously, folks, if you would like to get some help in trying to figure out how to navigate your portfolio through the road that may lie ahead, highly recommend that you get that from a good professional financial advisor, but importantly, one that takes into account the macro issues that Axel and I talked about today and that I talk about with the experts on this channel week in and week out. If you don't already have a good financial advisor who's advising you that way, highly recommend you consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form over at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments expected to work with these firms. It's just a public service they offer to help as many people as they can. Axel, my friend, again, really appreciate you coming on and doing this. It's going to be interesting, whatever happens here. By September, we should have a clearer sense, I think, of what the impact is going to be on the tariffs. And who knows, maybe it'll be enough for Powell to make a decision one way or the other.
All right. Thank you.
All right. And everybody else, thanks so much for watching.
We're moving into a new digital system. I believe that this will now usher in the hyperinflation to burn off the debt that's being created. So we'll have Amazon stable coins and Walmart stable coins and Kmart stable coins and, JC Penney, as well as JP Morgan, as well as Hong Kong stable coins, the yuan stable coins. So it is an extraordinarily fragmented market, but they are thinking that within the next 2.5 years, by 2028, they will go from about 125 billion stable coins to $2 trillion in stable coins.
Stablecoin adoption is accelerating, with issuance doubling to $250 billion from $120 billion. Offering a more tempered outlook, JP Morgan estimates the market may reach $500 billion by 2028. Meanwhile, forecasts suggest the market could grow to $400 billion by year-end and $2 trillion by 2028, citing limited mainstream adoption and regulatory challenges. Yet, only 6% of usage is tied to real-world payments, while most remains in trading and DeFi. The Genius Act is shaping regulatory clarity, boosting institutional interest as major players like JP Morgan, Amazon, and Walmart explore stablecoin models. Analysts see them becoming core payment infrastructure, bridging fiat and digital money in a hybrid financial system. The speaker, Lynette, the chief market analyst at IDM Trading, argues that silver and gold are massively undervalued compared to their true historical ratios and fundamental worth. Based on a traditional 20-to-1 gold to silver ratio, silver could be valued between $1,300 and $2,000 per ounce, while gold's fair value could range from $33,000 to $40,000. Current spot prices are seen as artificially suppressed by paper derivatives, but since both metals are sound money, they cannot be inflated away like fiat currencies. In times of crisis, gold and silver act as a bridge, preserving purchasing power as overvalued fiat-based assets, and real estate collapse, enabling wealth transfer to those holding real money. Looking ahead, Lynette warns of inevitable hyperinflation as currencies lose credibility. In such scenarios, governments historically revalue gold to restore public trust, often after lopping zeros off collapsing currencies. While gold and silver prices would soar during hyperinflation, gold has historically held elevated value longer than other assets before being adjusted, only to climb again under the new system. This pattern, repeated throughout history, is expected to play out again. As we present clips from the video, firstly, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
What happened in 1980 at that $50 mark, I consider this a massive double cup because it did come up to breach that level. And so when it goes above that 50, would 3 or even 4 digits in the silver nominal price, the price that we see, would that be outrageous? No, it's worth at a minimum $1,300 an ounce. And that's just based on the 20th to 1 that historically we were. These were both, well, it's a peace dollar. Okay. These are both $1, little $1 gold coin and a silver dollar. So that's a 20-to-1 ratio right there. So according to my calculations, you're looking at the true fundamental value of an ounce of gold at somewhere between $33,000 and $40,000 an ounce. So at $3,400, spot gold is a ridiculous bargain. But that also then means that silver's fundamental value at this moment is somewhere between $1,300 and $2,000. And remember, the more of this that they do, the higher those numbers go, because this is fiat money, government debt-based money. But gold and silver are sound money. Sound money is money that governments and central banks cannot inflate away. They can manipulate what you see through the use of garbage derivatives, but they cannot inflate it away. The point is they are both money. They're just the opposite sides of that money coin. And as this loses more and more and more of its purchasing power value, these go up in nominal terms. But what they really do is they create a bridge, because when one currency goes away, another one comes in. It's just that you need something and I need something. We need something that will hold its purchasing power intact to get us from one system into the next system. And dare I say it, even have the ability to take advantage of the opportunities that will present as these extremely severely overvalued fiat money assets. And real estate is actually not pure fiat money, because it is a tangible as well, but it's severely overvalued. That's going to flip flop. So if you can hold your purchasing power intact, you're going to be able to have that wealth transfer your way. Well, I personally do not see it. I see it as inevitable, because what gold really does is it regains confidence. I mean, they want us to think that gold is an old relic, except wedding rings are generally in gold. You know, good as gold. It's in our vernacular. It's in our DNA, and it's used to regain public confidence after that massive failure, which I believe we are like this close to experiencing, and the hyperinflation. But make no mistake, every single country has a gold revaluation account. They're not going to do it at these levels because it does not reflect all the paper money that's been issued. So what I think we will see, and it's just a repetition of history, because this has happened over 4,800 times. I don't think this time is any different, and that's really what the point is. But they have to, you have to kind of back up to move forward. If they did it now at the artificial level that the spot markets are, then it wouldn't have as great an impact if they wait until they finish blowing up the currency in a bout of massive hyperinflation. And what they do then is, of course, they lop off zeros so people think, well, they've got this under control. So you've got a loaf of bread. And I know this sounds outrageous, but it's not outrageous. It is just a repetition of history, where a loaf of bread might go for, as it enters hyperinflation, a loaf of bread might go for $80,000 a loaf, right? But then what happens? They lop off 3 zeros or 4 zeros as they do that overnight revaluation. And so it goes from $80,000 a loaf to $8 a loaf. But so do your savings, and so to anything that you've accumulated in fiat. And frankly, so will the nominal price of gold. First, it'll go up massively, right, in the hyperinflation. But the difference between, say, your stocks and everything else, that drops dramatically immediately upon the revaluation. Whereas gold, it's on average, so I can't guarantee this, but on average will stay up at that level for about 9 months before it too gets revalued, but then it instantly begins to climb again in terms of that new currency. So that is what I anticipate seeing. I don't anticipate seeing it before we do hyperinflation, because there is not yet the need to regain that public confidence. But I watch that like a hawk, because that, my friend, is the only thing that's keeping all of this stuff together.
The $50 silver level from 1980 remains important because it highlights how heavily manipulated these markets are. Just as gold and silver were once taken from the public and openly admitted to be manipulated by governments, today's spot prices don't reflect true price discovery, with LBMA inventories dropping sharply before partially recovering, while silver holdings remain much lower. This underscores silver's dual role as both an industrial and monetary metal, making it more vulnerable to hidden maneuvers. ETFs like SLV also expose this manipulation. Their structure was altered so they no longer need to back shares with actual silver, That leaves ordinary investors holding paper claims, while powerful players like JP Morgan or Saudi Arabia could still take delivery of the physical metal. This setup creates a backdoor way for institutions to control silver supplies, while the risks and losses are pushed onto the public, who falsely believe they own real silver through these trusts. Let's shift our attention towards the interview.
Yes, I definitely do think that triple digit price. Now, one thing that you mentioned about 80s with the Hunt brothers accumulating silver because they wanted to leave the US and form their own little country in Texas. However, the importance of that should not be just trivialized or ignored, because what we were really dealing with was an overt manipulation by our government of the silver markets. And everybody was warned. And I have to say, Jesse, I have often wondered when these things that happened and they seem outrageous to me, like taking the gold away from the population, like taking the silver away from the population, like a sitting president admitting that they're going to manipulate the markets. And I used to wonder how they could get away with that, why people didn't rise up and say, no, you can't do that. That's crazy. Well, I think we're living through that right now. And I'm seeing it happen. I think there's a lot of blindness that's going on. So I do actually consider the $50 mark nominal, to your point, to a very valid point, because these markets are manipulated. They are admittedly manipulated. And so if anybody really expects there to be any level of good price discovery with spot gold or spot silver, and I always make sure I say spot because that is just a contract. And when you're talking about silver, there's a chart from the LBMA that they came up. And of course, we know that there was a huge rush of physical coming into America at the beginning of this year. And you can see the stores in the LBMA dropping in gold, dropping and then rising again and coming back pretty close to the levels that they had before whatever came out of the LBMA. I'm actually more interested in what came out of the BOE, but let's just stay with the LBMA for a minute, because the same kind of issue with the physical metal being shipped over happened with silver as well, but their stores are significantly lower than they were before that physical push into the US. So what does that tell you? It tells you that silver gets used up in industry. And just like the SLV silver ETF that is supposed to be a basket of silver, they couldn't put the basket together. So back in, I don't remember whether it was 21 or 20, but they changed the prospectus. SLV changed its prospectus so that they didn't actually have to pull a basket of silver in, but rather all they had to do, which is what they were designed to do anyway, which is imitate the spot silver market. I think we could see that because silver is the secondary monetary metal, but it is rather, I'm pretty sure that Saudi Arabia would be considered an administrator, which means that they would, you and I can't do it, but they would have the ability to take possession of the underlying silver. So I think that is a manipulation to make that happen, because that can happen even more invisibly than what we were just talking about. And since silver is used across every single sector of the global economy, in solar, in medicine, et cetera, and gold is as well. Both of them are, but silver more so straddles that world. I think that this could also be a maneuver to ensure that they get their hands on the physical silver. At the end of the day, the holders of SLV won't. I mean, the normal holders of SLV wouldn't, but JP Morgan would and Saudi Arabia would. So I think it's a backdoor way to do it and have control of it. But the real problem is it would have to be done strategically. Like I would have to, I'd be curious to see how much of a percentage of the holdings that they already have in silver that would actually represent. Because if they did take out the physical at the same time that SLV itself, that trust, is selling off bits of silver on a daily basis to pay the rest of the fees, the repercussions for the public would be huge. Those that think that they actually own silver with an SLV, they don't. They just own shares in a trust. But that could have some really significant significant impact on the risk transfer to the public.
The rise of digital currencies, the undervaluation of gold and silver, and the ongoing manipulation of precious metal markets all point to a fragile and shifting financial system. As fiat currencies weaken and hyperinflation risks grow, physical gold and silver remain the most reliable anchors of purchasing power, offering protection and opportunity during systemic transition. The real question is not if, but when this reset will force the world to rediscover the value of sound money. Do you think central banks will allow the public to benefit from gold and silver's true revaluation? How should ordinary investors prepare for a financial reset driven by digital money and precious metals? Please share your thoughts in the space provided for comments below. Please remember to subscribe to stay updated and to give this material a thumbs up if you found it helpful. We appreciate you coming along on the ride.
I think that the precious metals rally is saying that inflation was much higher than what the government was publishing in terms of CPI. The gold price is reflecting collapse in the purchasing power of money. And now the gold price is probably reflecting the cost of living increases between 1971 and today, rising strongly. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. Gold would be a reasonable alternative.
The recent rally in precious metals like gold, silver, and platinum likely reflects much higher real inflation than official CPI figures suggest. Since the US left the gold standard in 1971, the purchasing power of the dollar has collapsed, and gold's rise is tracking the true increase in the cost of living over time. Ray Dalio says markets risk a hard attack from rising debt costs in the US and suggests holding 10 to 15% of one's portfolio in gold as protection. Moreover, Goldman Sachs warns of this scenario. The idea is that political interference could damage trust in traditional assets and the dollar, making gold more attractive. In the near term, new highs in metal prices are possible, and gold remains a strong long-term store of value. The speaker, Dr. Mark Faber, often called Dr. Doom, is a Swiss investor, economist, and market commentator. Gold's rise since the US left the gold standard in 1971 reflects the loss of money's purchasing power and higher living costs. Markets don't move in straight lines, they surge, correct, then resume upward. Over 10 years, gold would be a strong long-term choice compared to stocks or bonds. Gold is up nearly 40% this year, outperforming most assets as Fed rate cuts, a weaker dollar, central bank buying, and inflation fears drive demand. Forecasts put gold between $3,700 and $4,000 by mid-2026. Treasuries remain debated, with long bonds seen as fragile, while short bonds or cash offer optionality. Still, gold and miners are favored amid economic and policy risks. In downturns, gold is viewed as insurance. Mark Faber specifically mentions the mining stocks like Barrick and Newmont. Barrick is streamlining by selling non-core assets to focus on top gold and copper projects, though production and regulatory risks remain. Analysts view it as undervalued. Newmont has been upgraded to outperform for its turnaround, strong cash flow, and leverage to rising gold prices. Both miners are seen with significant upside, potentially doubling if gold's rally continues. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the video.
The gold price is reflecting the collapse in the purchasing power of money since the US abandoned or exited the gold windows in 1971, August 1971, when gold was at $35. Now the gold price is probably reflecting the cost of living increases between 1971 and today by rising strongly. That would be my view. But as you know, markets don't move in a linear fashion. They move up strongly, then they overshoot, then they correct for a few years, and then they resume their upward trend. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. That I wouldn't rule out. And equally, you know, if you ask me, Mark, you have to go to jail for 10 years. It's always a possibility. And then you have to invest your assets in one asset class and only one asset class. You cannot diversify. So you can choose properties, or you can choose stocks, or you can choose bonds, or you can choose gold. And you have to choose this and leave it until 10 years hence, 10 years later, when you get out of jail and want to collect your assets. In that case, what would you invest in? In stocks, bonds? I mean, I think gold would be a reasonable alternative. I mean, I've never been terribly keen about mining companies, but starting, say, about 9 months ago, I wrote that for the first time I was rather positive about mining companies because they were incredibly low compared to the price of gold, which had gone up substantially. The mining stocks hadn't gone up, but this year the mining stocks rose substantially. And I still like mining companies. I want to explain to you why I like mining companies. I think if you look at Barrick or Newmont Mining, the stocks have gone up, but they're not meaningfully up compared to previous highs. So I'd say this is a sector in the market. You asked me about value in the market, what it was desirable. I think mining stocks are very desirable. I think Barrick and Newmont, they can easily go up another 100%. I think US Treasuries is an alternative, not ideal, but say relatively favorable. And then cash is not a desirable investment, but it may be better than other assets in a downturn. You understand? You're not going to make money.
And it gives you optionality. You have optionality in case.
Yes.
You have opportunity.
But my sense is that if everything goes down, I tell you, it will be very difficult for you not to lose money. But let's say everything goes down 50%. Like in the Depression, it went down everything 80% or so. In that case, you're the king if your portfolio only drops 20%.
Mm-hmm.
You understand? The market assets go down 80%. And you are among the fortunate ones where the asset value drops 20%.
Mark Faber points out that the dollar stayed strong until late 2014, mainly due to capital inflows, not fundamentals. Trump's policies weakened global confidence in the U.S. Meanwhile, the U.S. is in recession despite official denials. Recent analysis highlights that inflation remains sticky, with real interest rates often negative and underlying price pressures not fully reflected in official CPI data. At the same time, a weakening dollar, growing doubts about central bank independence, and geopolitical risks are driving investors toward precious metals. Gold, silver, and platinum are increasingly seen not just as profit opportunities but as safe havens and long-term stores of value. Now, let's just reflect on the interview.
The dollar has been exceptionally strong until November 2024. And it has weakened since then. And if you say, or if you argue that it was in the cards that the dollar would decline, then I agree. The dollar has been strong, but not based on fundamentals. It's been based on capital flows. In other words, the world moved capital into US assets, and so the currency remains strong. But I think Trump has done a lot to destroy to destroy the confidence people had in America. The bond market in the US should rally because we're heading into a recession. I think we're already in a recession, but of course, Trump and his henchmen will argue, no, we are doing extremely well. And the economy is exceeding expectations, and so forth and so on. But the reality is that if you look at the living standards of ordinary people, they're not doing well. No way. And the wealthy people, including myself and so forth, we benefited from asset appreciation and did very well in the last 30, 40 years. Ordinary people that have no assets, they've been hurt because their cost of living is going up much more than their salaries. So ordinary people get squeezed. And ordinary people is 70% of the US economy. There are instances where when they cut rates, the market goes up, and there are instances where it goes down, depending on the expectations that preceded the interest rate cut. But in the present situation, a 25 basis point cut wouldn't do anything. That is expected. 50 basis points, I think the bond market would react favorably, but not hugely. I mean, my view is the bond market will go and sell and trade until the yield on the 10 years is between 3 and 3.5%. Because I think the economy is much, much weaker than what the Trump team pretends it to be. Most people aren't doing well economically.
Mm-hmm.
Now, is Jeff Bezos doing well economically? Yes. There, say, 500 people in the US that do exceedingly well. There are another 10,000 people that do relatively well. And then there are zillions that don't do well.
Do you agree with Dr. Faber that gold is the most reliable long-term store of value compared to stocks or bonds? Could mining stocks like Barrick and Newmont really double in value if gold continues its upward trend? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now. But the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work, and if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls. All credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold-to-silver ratio potentially falling from 90-95 to 1 back toward its historic 15-to-1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the Endgame Investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland Allison Act, 1878, and Sherman Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15-to-1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've been talking about the pyramid, right? And gold is at the bottom, but underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading, and the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, it was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. What happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. Right? And so they had a lot of gold. So what's the best way, if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor, for the favor of the rich. We have to go through a reckoning. That's natural law. Like, just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal, that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like, the bell's ringing. Okay, well, dollar has collapsed. It's going to be at a 15-to-1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two, 3. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve, or however you think the banking system functions. Well, what does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like, if the South had won the Civil War, you'd have the Confederate States and the Northern United States. So, might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting, they're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation-y or something, or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. Prices are actually, they've been going down since 1960s. I mean, if you look at everything priced in money
And gold.
Money, I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, so then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up. But you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. That's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. So it's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think, but you can't go completely into their world. But you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to. It's a very difficult position where we are, because we have to put a leg in the illusion and we have to keep a leg out of it and keep our minds together, which is it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me. That only I think in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver in this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.